Those of you, maybe not this stage in your life, but your parents are. Look to inheritance taxes. Going to be a major issue. Of course, you hear that in the news now. We're going to extend this and that or whatever. I think what's coming down the pike, folks, is it's writing all over the wall, is that we may increase the amount of dollars that can be passed on at death, but there's going to be a death tax because we have already spent the money down in Washington. That's the problem, all right? And I think it's too easy. We see played up now, but it's only the rich with the problem, all right? As we locally, we're in an agrarian culture. See, we're part of this problem. I could have a farm worth $1 million, $1.5 million, 100 acres. Not a big deal, really, all right? By now, to the world standards, look like a multi-millionaire, and at the same time, my meager little farm, you know, I'm in my 50s, not really pouring it on anymore with the expenses. I might make $50,000, $40,000, not an unreasonable amount of income, all right, average. So that's why it's a bigger issue for us passing those things along at that stage, but nevertheless, I think it'll just become a political issue. So there could be a circumstance where you apply insurance. You will do what is known as a second to die, sometimes on parents. If dad dies first, no big deal. No tax consequences. Mom still owns the farm. Mom dies, whew, big tax problem, 50%. All right, where do I come up with that tax dollar? All right. So a second to die policy, usually about half the cost of a regular policy, would be on your parents. They can gift the money into insuring that policy, tax-free flow out of money to you to pay the taxes, and the farm can stay in the family. All right, so there's an application, again, of insurance done with the state tax deductible dollars. That's a real quick example, but this is the purpose of introducing you to concepts. So, auto and home insurance, probably something that all deal with. Simple advice here, but examine your deductibles, whether you should carry comprehensive and collision. Again, as a rule of thumb, if clients call us or my office, I pretty much have some staff that do this for me now, but for the most part, I would always advise clients, if a car gets to be about 6 or 10 years old at the most, I question whether you want to keep comp and collision on it, all right? Merely, you are not taking away your being able to drive it. You still have your liability coverage. But the question is, if you're in an accident, if it's not your fault, the other guy's insurance company fixes it for you, all right? If it is your fault, then you're determining if my car is worth $5,000. If push came to shove, do I have the resources to come up with this $5,000 or whatever it takes to replace the car? If you do, then maybe you want to save that couple $100 every year out of pocket. You then know your circumstances. Maybe you've never had an accident. You're a very safe driver, all right? Play those things out and look at that. Simple ways to make savings there. Be aware of your liability levels. Consider a PCAT if your exposure is significant. Quite often, now what the biggest challenge I think, or biggest suggestion I have my staff impressing upon folks is the need for a PCAT. This is what you'd sometimes know as an umbrella liability policy. Covers your home and your auto. Usually start out at about $1 million. But in this world, we are in a secular world. If you get sued, $1 million doesn't go a long way, all right? PCAT is simply a liability extension over and above what your auto or your home already has on it, all right? So in other words, if I'm carrying $300,000 of liability, which is pretty standard, you come get auto or homeowner's insurance, you bought a property, you get homeowner's insurance, has $300,000 liability to it. What that does is add to it $1 million on top of that, all right? But it's just the way things get put together. It doesn't seem, if you have good earning capabilities and years ahead, you get a house or have a business started, there's just too many things that somebody would come after, and I would recommend, especially you get a pool. What you'll find with our company, the line is you need a PCAT, all right? Because just the accident threat from having guests over is just too great.
No pool, honey.
Hey, PCAT is $150 a year. It's not a big deal, okay? But, but I just think it's prudent to look ahead for that. Oh. Long-term care. Again, may not be the thing that you guys are concerned about, but I'll bet, all right, you should be more concerned about because your parents are probably getting to these ages, all right? Long-term care is the prevention so that we don't outlive our assets, our monies, all right? Normally, living too long is now a greater risk for many than dying too soon, merely because the biggest generation, the boomers, are starting to retire now, all right? And as a result, that's the generation that probably, they've outlived the primary. You're gone. You're the children of the boomers, all right? So their liability or the responsibility for raising you is over, all right? You're probably not pouring a whole lot of income back from your parents to support your families any longer. So their greater and their greater risk that they are experiencing will be living too long and running out of the assets that maybe you hope to get. So that's something we want to look at. Annuities. Another product, this is a financial product, and you'll hear about these things. This is a product that's designed to allow for your income to never be outlived. Those of you who are public school teachers, all right? You're getting, well, even if you're in any kind of a business, could be Armstrong has one, Hershey Foods has, they have, anywhere there's a pension, all right? Annuities are involved in those because they're put together, they're calculated, such that when you retire now, there is a promise that goes with your retirement of how many dollars for the rest of your life. It's annuitized, all right? Now you can change the promise. You can say, well, I got a wife. I want my income to provide for her as well, all right? I won't like those numbers because when they take my income and lower it because my wife is so many years younger than me, I won't like what that does. But nevertheless, we can deal with that too, all right? But an annuity will provide that I can never outlive my income, all right? They can be used. There's good purpose. What you are finding right now, and the current administration is actually doing good for this industry, but they are looking to apply some of these types of things and want to put that into as maybe potential cures for the pension problems, encouraging us to do more spending or saving on our own, obviously. But there are living benefits that some insurance have come up with now, whereas you can still tap your principal and have a guarantee of what amount of income you're going to be accruing over the years. So that has been a real plus there. I think that's it. That is the application. Let me actually have a blue screen to look at. That is essentially coming through the general layout of what I was going to touch base on in a general fashion. Are there any specifics now that you see essentially the types of things we can suggest in this industry? Hopefully the biblical principles to how they're applicable, how they are biblically supported, but what's helpful to you as you play it out.
How do you, like for instance, say you're considering long-term care insurance,
Mm-hmm.
how do you find a good provider? Like how do you know how do you find someone?
Like anything else, there are websites that you can go onto that are going to evaluate the companies, all right? See the strength. I think it's important to, my observation, it would be important to go with strong companies. I don't like to be the little guy. They need to be strongly backed. What is quite common in the industry, now that has changed the industry since the long-term care industry has evolved really in the last 20 years, about since the time I started. But early on, there were a lot of little companies that everyone had a product for this. But what they knew is in order to try to buy market share, they were, if the going rate was, $1,000 for somebody that's 60, all right, their rate was $700, $600. So what they were doing is now we see that once we've bought into that and I keep your product, rate increase. And so that has been something that's been a challenge. Now some of those companies start to sort themselves out because people caught on to that. But some of the larger companies do not see major rate increases. You will find, though, that their prices are higher to begin with. So that is something. But I think when I get into those kind of products, I steer clients towards some of the more stable or larger companies because if I now, most likely those products are marketed as we get to about 60s or at the cusp of kids are gone and now we can see that. The earlier you start at these things, you kind of lock in premiums. That's good. But as clients start to come to me and they are working more towards a fixed income category, they don't want that premium increase to be going up 20, or 10 or so percent every couple years. It's just they can't handle that because their increase in their investment values are not doing that. So in that respect, that's how I would go about then evaluate that. I would look, analyze some companies, see what their investment strength is. Maybe look at some of the track histories. How often has their rates increased? And then you get a sense for, are they really kind of buy the business? All right, and if so, just be prepared. You're getting bought, you know. Because once you buy in, quite often your health changes as you get older, and you're stuck. And that's what they're banking on. You can't go anywhere else. All right. So that's how I would evaluate that. All right, Chuck.
For instance, going online to check out some of the information about those companies, do you have a particular website or a couple websites you can recommend?
There is if you call me at the office, I have a website for long-term care. I have it written down. I don't have it memorized.
What
All
about
right.
other insurance providers, or other insurance provisions providers?
You mean as how do they evaluate, or how do they?
Different
Okay.
segments of the market as far as the type of insurance that's available and who's providing it.
Okay. What I was going to say is this. The way you go about purchasing long-term care, all right, is that for the most part, insurance companies will provide it. There are some arrangements that can be made sometimes through certain homes, you know, but for the most part, the industry is insurance company provides it. You go wherever you want care.
What
All right.
about like life insurance or health insurance? Like, how do you find a good company in general?
Call me. I'll get you a good company. No. Again, it's the same criteria. I would look for their strength. I like to know their claims paying ability, and a lot of times you'll find it price is oriented that way. So, if you're comparing, somebody's price looks really cheap, I'd look further because for the most part you find they should be right in about. I mean, that's just general competition, and then comes down to who do you want to work with, you know. I do think that it is important to find a provider for that you either share the principles with, so that you know that the fashion in which he or she is assisting to give you investment advice from or insurance advice from are coming from the shared principles that you live by, or otherwise you may not be pleased with. I mean, there's a secular set to this that you won't find that I would work with.